People are really concerned about the next stock market crash. We got trade wars, interest rates, current debt levels, but luckily, there is an efficient way how to handle the next stock market crash. Hey guys, how's it going, and thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money. Please do not forget to subscribe. Now, I first want to apologize for this week. I didn't have any videos. I was coming back from vacation and some personal things were going on. So, we're back. So thanks for bearing with me. Now, the advice going into how to prepare for the next stock market crash is advice from a multi-billionaire. No, I'm not particularly the multi-billionaire, or maybe I am and you just don't know. But this is based on Ray Dalio's investment advice. He is the largest hedge fund manager out there. I did a previous video on that. I'll leave a link in the description so you could go into detail of what's going on. I'll be kind of touching on main points that he goes over, and there will be pictures coming up, because I know you like pictures. So now, you probably heard what to do before in a stock market crash. You could buy dividend paying stocks. You could buy bonds. You could buy gold. You could buy Bitcoin. Maybe not Bitcoin. You could buy other investments. But which is right? With this advice, essentially all of it is right. Minus the Bitcoin part. But, so let me ask you something. Have you ever been wrong before? Have you ever chose the wrong stock? Have you ever chose the wrong timing to buy that stock? The wrong buy, the wrong sell? I know I have. And do you think that you will be wrong at least one more time in the future? If you don't think you'll be wrong one more time in the future, you could dislike and leave this video right now. Alright, now that they're gone and we're filled with a bunch of non-delusional people, we can continue. So this is when the advice of Ray Dalio comes into play. You're essentially investing in any type of environment that is involving in the market. So there are 4 types of environments the market goes through. It could be increasing growth or decreasing growth, as well as increasing inflation, decreasing inflation. So if you invest in all of those different environments, you can have an all-weather portfolio. Sponsored by Ray Dalio. So yes, this is diversifying across basically everything out there to an extent. So you have to allocate your portfolio in a certain matter, which we'll be going into right now. So I was looking into different websites of how to backtest the stock market. Meaning, if you invested in, let's say, a certain amount of stocks, different allocations, back then, it'll show you how it performed throughout history and what would you have now. So there's a bunch of software out there. A lot of it's complex, a lot of it you have to pay for, and this is something I found free. I'll leave a link in the description so you can play around with it. I actually played around with it for like a couple hours, but it's definitely very interesting and you should. Now, the accuracy might be questionable because it is a free program. However, it's the concept that we're trying to get at rather than the specific numbers if it's off by 1 decimal point. So this is the website that I'm talking about, is Portfolio Visualizer. Again, I'll leave a link in the description so you could check it out. And you could see, you could set it up as you want. You could see the start year, end year, how much money you start with, rebalancing, and everything. Going down a little bit further, these are the different holdings that Ray Dalio either talks about, has in his own portfolio. Again, I have that video, link in the description. But this is the holdings that he's talking about. So it's based on him. So these are all different asset classes and everything diversified within those. So for example, I'll go through them real quick if you like to know. The first one is Vanguard Emerging Markets. The next one is Vanguard 500, so like similar to the S&P 500. GLD is gold, so you're mirroring the price of gold. LQD is investment grade corporate bonds. TLT is 20 plus year treasury bonds. HYG is high yield corporate bonds. EMB is emerging market bonds. And last but not least, if you like to have some cash on hand, this is straight up cash. Long-winded, sorry, stay with us. But you can see all of these are different. There are emerging markets, so not only in America, all over the world. Some funds are strictly America, for example, the S&P 500. Some are against the market, for example, gold. So usually when stocks go down or stocks crash, people flood to safe havens like gold. Also bonds. They're considered safer. If you look at the last crash in 2008, it was actually shown that bonds are highly correlated to stocks. So a lot of bonds actually dropped just like stocks did. But that's why he has treasuries, short-term, intermediate, and long-term, 20 plus. They're definitely safer. They kind of maintain their value. All right, so we're getting to the graphs and colors right now. So I just put different portfolios just to play around with it, so you could see that you could change the percentages if you'd like. So looking at the chart, we can see portfolio growth. Now this is starting in 2008 because some of the funds didn't exist before then. However, you can see that the yellow line is the Vanguard 500. So this is the S&P 500, basically the overall stock market. Now you can see the portfolios that we created. Looking back to what we kind of had a bit of everything. You had some emerging markets, some American companies, mostly bonds, a lot in treasuries, some in gold, some in cash. And you can see how that performed. So by the way, we started with $10,000 and the stock market dropped. And if you had an S&P 500 fund, you would have $5,100 versus possibly our portfolio that we created. It dropped as low as $8,600. So obviously a lot less volatile than the overall stock market. And this is because of Ray Dalio's idea of an all-weather portfolio. You still want to invest in a bunch of other things because, like we said before, you and me can be wrong. So you might think that stocks are going to go down, and they don't. A lot of people say the crash was going to be coming for a few years now, and it hasn't. The market is still making all-time highs. So you still kind of need those stocks in there just in case it keeps rising. However, you need those other forms of assets as well, like gold, like bonds, and so on. So you can see something very interesting with this graph. Everyone basically says that if you invest in stocks for the long term, just buy and hold, don't worry about it. Yes, stocks usually, probably most times, if not all times, outperform other allocations. For example, bonds. They vastly outperform bonds in the long term. However, let's look at the chart right now. The portfolios that we created, looking at the blue and red lines, they did not drop and outperformed the S&P 500. Now, if you're looking at the long term, yes, the S&P 500 did outperform. However, and this is what makes it very interesting, if you're able to avoid a market drop, why wouldn't you? So again, if you're watching this video, most likely you're probably unsure about the stock market. You might jump out at the wrong time, you might jump back in at the wrong time. So instead of avoiding that, you should adjust allocations. Similar like this. Play around with the different percentages, but you can have a heavy bond holding, heavy cash, heavy gold, any type of investment. You could go into T-bills, you could go into real estate even. So if you look at this real quick, why we're choosing all these different assets is because it's uncorrelated to the overall market. So the S&P 500's correlation is 1. Simple. However, the other portfolios that were created, let's say portfolio 1, has a market correlation of 0.36. Meaning, it does not drop as quick as the market. So yes, you can never time the market. However, you can play it a bit different. So if you do invest in, let's say, this type of allocation similar to Ray Dalio, and you don't drop as much, then when you're a little bit more comfortable and you're still above the overall market, you don't want to lose money. Rules of Warren Buffett: losing money sucks. So you would lose less, and then you could start allocating a bit differently, let's say after the market crash. So yes, if you're super long term, don't even look at your portfolio, and it's in an IRA, 401k, whatever, and you don't care, fine, go all stocks. However, if you are planning on trying to preserve something, trying to brace yourself, this could be a way, because if a multi-billionaire is doing it and even suggesting people to do this, maybe we should. And this strategy was from the book Money, Master the Game by Tony Robbins. Great book, very long. I would definitely recommend it though. Again, link in the description if you want to check that book out. So that's how you could prepare for the next stock market crash, guys. So if you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. Do you think this different asset allocation can help you? Should you go into heavy bonds to prepare for something like this, or just go all stocks and do whatever you please? So thank you so much for watching, guys. Good to be back. It's been a while. Thanks for bearing with me, and I'll see you guys in the next one.